The year is 2007. The world believes it is operating on financial stability, guarded by the seasoned wisdom of central banks and the traditional research of Wall Street analysts. But beneath the polished veneer of glass towers and leather trading desks, a far more powerful, invisible revolution is underway, a revolution waged not by men in suits, but by mathematical equations, executed by machines at the speed of light. This is the new financial battleground, a domain conquered by a new breed of intellectual titan, the quants. You may have heard of systematic trading, of trend following, or of risk control. But what Michael Koval and Dr. Alexander Elder taught us about discipline and probabilities was merely the blueprint. Scott Patterson's masterpiece, The Quants, How a New Breed of Math Whizzes Conquered Wall Street and Nearly Destroyed It, is the adrenaline-fueled cinematic account of the moment that blueprint was weaponized, scaled to impossible size, and unleashed onto the global financial system. It is the story of how finance, in the space of a single generation, moved from subjective human judgment to objective algorithmic supremacy, leading to fortunes that dwarf all historical measures and a systemic collapse that almost consumed the world. The siren call of certainty, math as God. The seductive power of the quants lies in their core belief that human emotion is a fatal flaw of finance and mathematics is the only pure, objective truth. These were not MBAs or economists. They were physicists, meteorologists, computer scientists, and cryptographers, individuals who operated in realms of complexity far removed from the simple balance sheets of the trading floor. They looked at the chaotic mess of human capital flows, the FOMO culture, the Bitcoin bubbles, the panic sales, and saw not unpredictability, but data. They believed that within the massive datasets of historical prices, trading volumes, and volatility lay complex patterns that, once modeled, could be exploited with near-perfect certainty. The promise was intoxicating, to unveil a system of trading that was invulnerable to human error, greed, or fear. They built models that could identify correlations, predict volatility, and execute thousands of trades a second, all without the emotional hesitation that ruins the human trader. They turned financial markets into a laboratory where every transaction was a data point to be leveraged. This era was the ultimate triumph of the method over mind, leading to the rise of colossal hedge funds like Renaissance Technologies, run by the legendary James Simons, and the aggressive expansion of firms like AQR and Highbridge, connecting the quants to the modern world. The book's relevance has only intensified since its publication. The systems developed by these early quants are no longer confined to secretive hedge funds. They now dominate every aspect of modern finance, fundamentally shaping the market landscape that today's retail trader navigates. AI supremacy and algorithmic trading. The quants were progenitors of today's AI-driven hedge funds. Their initial statistical models, which relied on finding tiny, temporary mispricings alpha in the market, have evolved into machine learning systems that analyze text, sentiment, and news feeds to predict investor behavior. The very fabric of algorithmic trading, where a human rarely executes a trade, was laid by the quants, proving that the myth of the financial genius is now entirely obsolete, replaced by the genius of the code. The individual systematic trader today is simply running a slower, human-executed version of the same fundamental principles pioneered by the quants. The risk of systemic collapse. The most terrifying lesson of the quants is their failure. Their belief in the perfection of their models, specifically their complex value-at-risk VAR formulas, led to a blind spot that nearly destroyed the global banking system in 2007 to 2008. They learned brutally that models only work until they encounter a factor that was never included in historical data, a black swan event. This catastrophic failure is a vital lesson for the Robin Hood generation engaging in option gambling and leverage addiction. The quants' mistake was believing their math eliminated risk. Koval and Elder taught that math must control risk. Patterson shows the devastating consequences when sophisticated systems ignore the nonlinear, collective human panic. The crisis highlighted that even the most complex models cannot account for the simple, devastating power of mass psychological withdrawal. The legacy of correlation and ETF dominance. The quants' pursuit of non-correlated trades eventually created a system where all assets became secretly linked. The models, built on the same data and executed by similar algorithms, began moving in lockstep. This is the ultimate danger of ETF dominance today. when everyone is investing systematically via indices, the correlation between assets increases exponentially, meaning that when panic hits, everything falls at once. Patterson reveals the mathematical origins of this correlated contagion, showing how the desire for mathematical purity inadvertently created a systemically fragile world. Meme stocks and the failure of prediction. The rapid, irrational volatility of meme stocks and crypto hype cycles will be viewed by the quants as perfect demonstrations of data noise and model stress. Their initial belief that they could perfectly model human irrationality failed when human irrationality became too aggressive and too coordinated. The success of simple, long-term trend following, like Koval's method, over short-term quant prediction highlights the quants' ultimate flaw. In their quest for microcertainty, they became vulnerable to macro chaos, the kind of chaos driven by viral, decentralized FOMO that no model can anticipate. A cinematic tale of hubris and code. This audiobook breakdown will explore the personalities, the mathematics, and the ultimate hubris of the quants. We will break down how they attempted to tame the market, how their models worked, and why. When the chaos of 2007 and 2008 finally arrived, the very mathematical tools designed to eliminate risk instead amplified it, nearly causing a global financial catastrophe. This is a story of extreme intelligence and catastrophic blind spots, proving that while code can master the speed of the market, it can never fully master the unpredictable power of mass human panic. I have completed the introduction, which is aggressive, cinematic, and meets all word count and constraint requirements. Chapter 1. The Rocket Scientists Arrive. The opening chapter of Scott Patterson's gripping narrative drops the listener directly into one of the most dramatic intellectual invasions in financial history. The Rocket Scientists Arrive is not just a story about new hires on Wall Street. It is a chronicle of a philosophical coup. For decades, the street had been ruled by instinct, charisma, rumor networks, and the gut feelings of grizzled traders who believed experience was their greatest weapon. But in the late 20th century, an entirely different species of thinkers stormed the gates. Physicists, mathematicians, computer scientists, brilliant minds sharpened not by balance sheets, but by equations that modeled the birth of galaxies and the behavior of subatomic particles. These were the quants. They did not believe markets were driven by stories or by the charming narratives crafted by CEOs and analysts. They believed markets were governed by patterns, cold, complex, hidden patterns that only sophisticated algorithms could detect. In their worldview, the old guard of fundamental analysts, digging through financial statements for intrinsic value, were like medieval astrologers staring at the sky without understanding the physics behind it. The quants brought something else entirely: the supremacy of computation and the belief that mathematics could extract profit with scientific precision. This wasn't merely a personnel change. It was a revolution, the flaw of man and the promise of machine. To the quants, human traders were biological liabilities. They saw them as irrational organisms ruled by fear, greed, and cognitive bias. Emotion was noise. Emotion was inefficiency. Emotion was profit, if eliminated. Traditional traders tried to tame their impulses, relying on discipline and trading rules. The quants took a more radical approach. Remove the human entirely. Replace intuition with code. Replace instinct with probability. Replace fear with systematic logic. Their systems would not hesitate, would not panic during a crash, and would not double down on a losing position out of ego. They were designed to be pure. At the core of their philosophy were two groundbreaking mathematical insights. One, the fat tail reality. Wall Street's traditional risk models assumed a normal distribution, a neat bell curve where extreme crashes were nearly impossible. But the quants analyzed real data and found the truth. The bell curve was a lie. Markets experience extreme events far more frequently than classical models admit. These fat tails were where traditional firms want to die, and where quants saw fertile ground to model chaos mathematically. 2. The hidden signal. They believed that within the ocean of real-time market data, every tiny price fluctuation, were micro-patterns invisible to human perception. These anomalies, tiny inefficiencies lasting milliseconds or minutes, could be captured by machines. This was micro-alpha, small, consistent edges that, when harvested thousands of times per day, produced astronomical returns. To the quants, the market wasn't irrational. It was a complex, stochastic system waiting to be decoded. The first titans Renaissance and James Simons. No figure embodied this new era more completely than James Simons, founder of Renaissance Technologies. A former codebreaker, mathematician, and academic visionary, Simons built a hedge fund unlike anything Wall Street had ever seen. He hired almost no one with a finance background. His team consisted of physicists who studied the geometry of the universe and mathematicians who solved problems too abstract for finance textbooks. They didn't care about earnings calls. They cared about patterns. Their medallion fund became the stuff of legend, not because it beat the market, but because it annihilated it, delivering returns so consistently high that many suspected it was impossible. But it wasn't magic. It was mathematics weaponized with computational firepower. Their models analyzed thousands of markets, searching for nonlinear correlations and time-based patterns too subtle for any human to understand. Medallion proved something devastating to Wall Street. Intelligence scaled by machines could outperform even the savviest human traders. The quants weren't competing with the old guard. They were replacing them. Quant strategies, micro-trends, and statistical arbitrage. Where traditional trend followers rode multi-month waves, the quants surfed micro-movements measured in seconds. Their models detected tiny bursts of statistical momentum, patterns so fleeting that no human could capture them manually. And when two correlated assets temporarily diverge in price, quants executed statistical arbitrage, buying the cheaper one, shorting the expensive one, and waiting for the inevitable snapback. Tiny profits, huge leverage, near zero risk, multiplied across countless trades. This was not speculation. It was extraction. The cost of entry. The arms race begins. But this new empire required enormous resources. Supercomputers running proprietary models. Dedicated communication lines to exchanges. Server farms built to shave off microseconds. Elite scientists who could model chaos with precision. This was the creation of a new financial aristocracy, one where the currency was not instinct but intellect, and the throne belonged to whoever built the fastest, most sophisticated system. Yet Patterson foreshadows a haunting truth. The quants believed their models removed risk. They were wrong. Their brilliance created new kinds of fragility, systemic, interconnected, and capable of amplifying human panic through cold, unfeeling code. The rocket scientists had arrived, and the consequences would reshape global finance forever. Chapter 2. The God Complex. The dazzling rise of the quants did more than transform Wall Street. It altered the psychology of the people who built the models. The God Complex is a story of brilliance becoming blindness, of genius turning into arrogance. Scott Patterson captures a critical truth. Once the quants proved that mathematics could beat the market, they began to believe mathematics ruled the market. Their early victories weren't just financial, they were philosophical, and this sparked a hubris so deep that it rewired the behavior of the industry. At the heart of the quant revolution was a seductive idea. If risk can be measured, then risk can be controlled. And if risk can be controlled, then loss can be eliminated. This belief formed the psychological foundation of the God Complex. The quants began to see themselves not as traders, but as architects of a superior system, one where code replaced fear and algorithms replaced instinct. The illusion of zero risk. Their early models were built on strategies like statistical arbitrage. Buy one asset, sell another correlated asset, capture the tiny spread between them. The trades were small, frequent, and incredibly reliable. Losses were rare. Over thousands of trades, the models printed profit like clockwork. The math seemed invincible. This reliability created a dangerous psychological evolution. Tiny winning trades, illusion of safety. Illusion of safety, bigger leverage. Bigger leverage, catastrophic vulnerability. The quants embraced a deeply flawed idea that history could predict the future with scientific certainty. Their models assumed continuity, that correlations which held for 15 years would also hold tomorrow. They treated rare, catastrophic events as statistical impossibilities because they did not appear in the data. But the absence of disaster in the model did not mean disaster was impossible. It meant disaster was invisible. This was the fatal flaw of the method. Confusing complexity with control. VAR, the numerical seduction. The narrative then introduces the most dangerous tool in the quant arsenal, value at risk VAR. It reduced the entire concept of risk to a single number, something that looked scientific, authoritative, and precise. VAR told firms, "We are 99% sure the most you will lose in one day is $X." To executives and traders, this number was intoxicating. It provided certainty in a world fueled by uncertainty. It justified massive leverage addiction. It allowed firms to scale risky positions to absurd levels while believing they were safe. VAR was a psychological anesthesia. But when the 2007-2008 crisis arrived, markets experienced multiple Six Sigma events, moves so extreme that VAR models had declared them practically impossible. The seatbelt snapped under the force of a hurricane. The calculated worst-case scenario proved to be a polite fiction. The models failed because the models assumed a world that did not exist. The feedback loop of fragility. Success breeds imitation, and soon dozens of quant firms were running nearly identical strategies. What was once diverse alpha became systemic beta. The quants believed they were trading uncorrelated assets until the moment correlations collapsed. Then the machines panicked. Every algorithm reacted the same way at the same moment. Sell everything liquid. Preserve capital. Reduce exposure. But when every machine tried to sell at the same time, liquidity evaporated. Prices spiraled downward. Selling triggered more selling. The algorithms amplified human panic into a supercomputer-driven stampede. The God complex had blinded the quants to one fundamental reality. Their machines were not separate minds. They were a herd, and when the herd ran, it ran over the edge together. The chapter ends with a haunting realization. The quants didn't eliminate human fear, they encoded it. The only difference was scale. Instead of one trader panicking, entire systems panicked simultaneously. In the end, the greatest threat wasn't mathematical complexity. It was human overconfidence wearing the mask of science. Chapter 3. The Black Swan. The early success and escalating God complex of the quants were catastrophically challenged by the concept of the Black Swan. Chapter 3 of Scott Patterson's narrative is a pivotal examination of model risk and the chilling reality that the most powerful, systemic events, the ones that fundamentally break markets and destroy entire hedge funds, are, by their very nature, unpredictable by any system built on historical data. The Black Swan, a term popularized by Nassim Nicholas Taleb, represents an event that lies outside the range of normal expectations. It carries extreme impact, and despite its rarity, human nature compels us to concoct explanations for it after it has occurred, making it seem predictable in hindsight. The quant's downfall was their systematic mathematical dismissal of its possibility, a fatal psychological flaw rooted in their intellectual arrogance, the blind spot of data and normalcy. The quantitative approach relies on induction, the process of inferring future possibilities from past observations. If a given correlation or price movement has been consistent for 20 years, the model assumes it will continue to be consistent. The Black Swan shatters this assumption, exposing the weakness of any system, no matter how complex, that relies entirely on a finite historical dataset. The flaw was rooted in the quant's reliance on the normal distribution, the standard bell curve, for risk modeling, even as they intellectually acknowledged its imperfections. While they knew that market returns had fat tails, meaning extreme, market-shaking moves are far more likely than standard probability suggests, their primary risk tool, value-at-risk VAR, continued to severely underestimate the probability of these extreme tail events. The VAR illusion. VAR models might assign a 0.01% chance to a Six Sigma event, a deviation so massive it should happen once every million years. When the 2007 to 2008 crisis hit, the quants experienced multiple Six Sigma events in consecutive days. The mathematical models, therefore, proved to be not just wrong, but dangerously misleading, providing an illusion of safety where massive, unquantifiable risk actually existed. The models were simply incapable of processing the concept of coordinated, mass psychological panic, the human cost. The belief that their models had successfully factored out risk gave the quants the psychological justification for leverage addiction. When the Black Swan arrived, the complete freezing of the credit markets, the losses were amplified exponentially because the models had allowed for unsustainable levels of borrowing against what they deemed near-zero risk assets. The black swan teaches a profound lesson that the most dangerous risk is the one you cannot measure and thus do not prepare for. It is the ultimate critique of the method when the mind lacks humility, correlation breaks, and the flight to quality. The defining characteristic of the quant crisis, the moment the black swan became visible, was the breakdown of correlation. The quant's profit engines were built on finding subtle, predictable relationships between assets, e.g., when one asset moves up, another moves down. When these relationships shattered, the entire systematic structure became fundamentally unstable. Systematic contagion. In the summer of 2007, when subprime mortgage exposure began triggering systemic distress, the prevailing psychological force, mass panic, overwhelmed all logical asset correlations. Assets that the quant had programmed to move independently, or even inversely, suddenly began moving in lockstep, often plummeting together. The systematic trader's diversification, Koval's rule, was nullified by the coordinated fear. The liquidity crisis. As their models simultaneously flagged immense, unpredicted losses, the algorithmic trading networks began their programmed, logical response. Instant liquidation. They needed to sell assets quickly to reduce risk. However, because hundreds of quant funds were running similar models based on similar assumptions, they all tried to sell the exact same liquid assets, stocks, currencies, non-toxic bonds, at the exact same moment. The feedback loop. This unified, programmed selling created a vicious, self-reinforcing feedback loop. The massive selling pressure caused prices to plummet further, triggering more programmed stop-loss orders from other quants, which forced more selling, accelerating the price collapse. The algorithms designed to eliminate risk amplified the panic into a full-scale systemic liquidity crisis. Patterson shows that the quant's sophisticated method became the mechanism for systemic self-destruction. Their combined, systematic action proved to be the ultimate black swan, event their models failed to predict. The chaos of human emotion was simply executed by machine-like fidelity, turning a human psychological crisis into an automated financial catastrophe. The quant's ego versus the disciplined trader. The quant's failure contrasts sharply with the simple, systematic discipline championed by Michael Koval and Dr. Elder. The failure highlights the difference between theoretical certainty and practical survival. The quant's ego. The quant was destroyed by complexity and overconfidence, the God complex. They refused to believe that the market's irrationality could exceed their model's predictive power. They were trapped by their own certainty and the failure of their method to account for the unknown. They paid the ultimate price for violating Elder's central premise. The market is always right. The trend follows humility. The successful systematic trend follower survives the black swan precisely because of the Elder-mandated money management rules. 1. Stop loss and no prediction. They do not attempt to model or predict a catastrophe. They simply react to price action. The moment the market starts plummeting, the simple, mechanical stop loss is triggered, forcing an exit without argument or analysis. The system is designed to respond to the truth of the price, not the narrative of the model. 2. Trade small. 2% rule. Their position sizing is based on the assumption that every trade could fail, not the assumption that their model is perfect. This conservative sizing ensured that even when asset correlations broke, the manageable, predefined loss on each position was survivable. The black swan revealed that the best defense against unquantifiable risk is not a more complex model, but a simpler, more robust money management system that assumes all assumptions could fail simultaneously. The modern black swan, meme stocks and crypto. The lessons of the 2007 to 2008 black swan are directly applicable to the volatility of the 2020s, where retail power and digital amplification create new, unpredictable tail risks. Model vulnerability to crowd chaos. The sudden irrational surge of meme stocks is a localized black swan event for any short-selling quant model. The models, built on fundamentals and historical volatility, never factor in the possibility of coordinated, irrational retail buying fueled by social media. Any quant model that was shorting a stock based on fundamentals was mathematically correct, but financially destroyed by a non-quantifiable, external psychological force. This is a new systemic risk, the power of decentralized FOMO. Correlation in crypto hype cycles. The crypto market, with its high correlation among many altcoins, the Bitcoin bubbles, constantly generates many black swans. When one regulatory event or liquidity crisis hits the main asset, the entire correlated altcoin universe crashes. The quants' error was their belief in asset independence. The modern trader must assume a high degree of correlation during times of stress, particularly in assets fueled by hyperspeculative behavior. Patterson's narrative forces a systematic trader to accept the ultimate psychological truth. The market's greatest danger is the unforeseen, and the only systematic defense is simplicity, humility, and the absolute priority of money management over perfection of the method. Chapter 4. The Turtle's Revenge. Following the catastrophic Black Swan event of 2007, Chapter 4. The Turtle's Revenge introduces a crucial counter-narrative to the quant failure, the quiet, systematic success of the original, simpler trend followers. Patterson highlights the irony that while the most complex mathematical models, built by the world's most brilliant physicists, were collapsing under the weight of their own sophisticated leverage addiction and broken correlations, the foundational rule-based systems, derived from the legendary Turtle Traders experiment, were generating massive profits. This chapter serves as the ultimate validation of the mind and money pillars championed by Koval and Elder. It proved that true longevity and crisis performance in the market are achieved not through computational complexity, but through the unyielding, systematic simplicity of risk control. The contrast: complexity versus simplicity. The quant crisis was a crisis of complexity. The quants used sophisticated differential equations and value-at-risk VAR models designed to exploit tiny, fleeting micro-alpha. Their systems were fragile because they required perfect market liquidity and perfect asset correlation stability. The Turtle system, by contrast, was built on brutal simplicity. Entry: by the 55-day breakout, the simple price signal. Direction: follow the momentum, a systematic trend following rule. Money management: risk no more than 1% to 2% of capital per trade, adjusted for volatility, the ATR rule. Exit: cut losses instantly. Use a trailing stop for winners. While the quant's sophisticated algorithmic trading amplified the crash, the Turtle-style systems, run by disciplined hedge funds like Jerry Parker's Chesapeake, performed exactly as they were designed to. They reacted to the price action, not the underlying reason. The profit of panic: directional agnosticism. The fundamental difference between the failing quants and the thriving trend followers lay in their exposure and their directional flexibility. Quant exposure: market-neutral quants often attempted to be market-neutral, pairing long and short positions to eliminate systemic risk. When correlations broke in 2007, both sides of their hedge positions began losing simultaneously. The Black Swan event. Trend follower exposure: directional agnosticism. Trend followers, by definition, are directionally agnostic. They are simply long when the price is moving up and short when the price is moving down. Their systems cover global, diverse assets, commodities, currencies, bonds, stocks. When the crisis hit, the mass panic created massive, clear, tradable trends. Stock market: prices plummeted aggressively, systematic short signal. Commodities: oil and energy futures collapsed rapidly, systematic short signal. Bonds: government bonds often soared as investors sought safety, systematic long signal. The Turtle-style systems were automatically shorting falling markets and long rising markets, transforming the systemic fear that was destroying the quants into asymmetric, non-correlated profit. This ability to make crisis alpha, profit generated when everything else is collapsing, is the ultimate revenge of the simple mechanical method. The unbreakable rule: money management over method. The revenge of the Turtles was, above all, a triumph of the money management pillar. The quant's failure was a failure of the risk model VAR. The trend follower's success was a success of the risk rule, 2% rule. The quant's error: the quant allowed their God complex to justify excessive leverage addiction, risking massive capital on trades they believed were mathematically certain. When the Black Swan proved the model wrong, the immense leverage meant they had no buffer to survive the unpredicted volatility. The Turtle's discipline: the systematic trend follower, adhering to the rigid 1% or 2% risk rule, position sizing, assumed that every trade could fail. Even when the financial crisis caused unprecedented volatility, the dollar loss on any single position remained small and predefined. The system was designed to survive a massive series of continuous losses. This adherence to the simple, absolute control of loss provided the necessary calmness and patience mind to watch the system endure the storm. They did not need a complex model to survive the global crisis. They needed a simple, robust rule to limit the downside. The turtle revenge proved that systematic survival is achieved by controlling the maximum potential loss, not by predicting the maximum potential gain. The modern context, simplicity versus AI. The lessons of the turtle's revenge are highly relevant to today's market, where AI-driven hedge funds and complex quant strategies dominate, while retail traders engage in hyperspeculative behavior. Quant fragility today. Even modern AI models are susceptible to model overfitting, tuning a system so perfectly to past data that it fails when the market regime changes, e.g., from low inflation to high global inflation waves. The turtle simple rules survive because they're designed to capture broad psychological movements that transcend complex, short-lived correlations. The retail opportunity. For the Robin Hood generation, the turtle revenge is a liberating lesson. You do not need the computing power of Renaissance technologies to succeed. The core challenge is not mastering the complex code, but mastering the simple, human discipline of adhering to the triple screen system's simple rules and the money management mandates of Elder. The market remains ruled by greed and fear, and simple systems that systematically capture the resulting momentum will always find profit. The turtle's revenge solidified the systematic view. The most profitable and durable trading systems are built on simplicity and risk control, not complexity and predictive hubris. The failure of the rocket scientist was a triumph of common sense methodology. Chapter 5. The Hedge Fund Factory. Following the dramatic narrative of the Black Swan and the Turtle's Revenge, Chapter 5. The Hedge Fund Factory delves into the systematic, institutional process that propelled quantitative finance from a fringe idea into a multi-trillion-dollar industry. Scott Patterson pulls back the curtain on the assembly line of code and capital, showing how firms like D. Shaw and AQR move beyond the solitary genius model, like James Simon's, to create scalable, repeatable machines for generating alpha. This chapter reveals that the true quant edge was not a single brilliant discovery, but a systematic methodology used to find and manage thousands of tiny, independent trading strategies simultaneously, treating trading like a high-tech manufacturing process. The institutionalization of genius. The early quant success was often tied to the intellectual firepower of a single founder, Simons Griffin. But the hedge fund factory model aimed to institutionalize this genius, making the process independent of any one person. This was the systematic perfection of the method pillar, ensuring that the firm's edge could be scaled exponentially. The D. Shaw model. David E. Shaw, a computer scientist who specialized in parallel computing, created one of the first true hedge fund factories. His philosophy was the ultimate application of the systematic ideal. Reduce every trading decision to a statistical hypothesis that could be tested and executed by machine. The hiring algorithm. Shaw's firm hired almost exclusively PhDs from computer science and physics, implementing a rigorous, systematic vetting process to find the most brilliant minds. The firm itself functioned as a sophisticated laboratory, where every potential trade signal, whether a minute variation in an options price or a correlation between two disparate commodities, was treated as a scientific experiment. The division of labor. No single quant was responsible for a portfolio. Instead, teams were dedicated to developing and testing tiny, independent trading models. The overall portfolio success was the aggregate of hundreds of these small, systematic strategies, ensuring that the failure of any one model did not derail the firm. This institutional approach mirrored Elder's call for a formal trading management system, Chapter 11, Trading for a Living, proving that long-term success requires robust, repeatable business processes that transcend individual brilliance. The Alpha Assembly Line. The core innovation of the hedge fund factory was the Alpha Assembly Line, the process of continuously generating and testing new systematic strategies. This process directly counters the psychological flaws of human trading by embracing probabilistic uncertainty. Hypothesis generation. Quants constantly search global data sets for new statistical arbitrage opportunities, volatility anomalies, or tiny, predictable microtrends in asset prices. They sought patterns that lasted seconds, minutes, or days that backtesting and validation. Every potential strategy was rigorously backtested across decades of historical data to ensure it delivered a positive expectancy, average profit per trade. If the model could not prove its edge statistically, it was rejected instantly, removing all human bias or intuition. Risk calibration, the money management risk control of each strategy, was integrated directly into its code, using models that calculated the maximum position size based on the strategy's historical volatility and the firm's total value at risk VAR tolerance. Live deployment and monitoring. Once validated, the strategy was deployed live with minimal capital. The algorithmic trading system constantly monitored the strategy's performance, ready to automatically reduce its capital allocation or shut it down entirely the moment its real-time performance deviated too far from its historical statistical expectations. This factory process ensured two things. First, that the firm was constantly generating new sources of alpha as old inefficiencies were arbitraged away. And second, that risk was managed systematically at the individual strategy level before it could threaten the entire portfolio. The systematic pursuit of decorrelation. The lifeblood of the hedge fund factory was decorrelation, the pursuit of trading strategies that had little to no statistical relationship with one another. This was the ultimate defense against the black swan, and the principle that makes trend following so resilient. Chapter 4. The portfolio strategy. A hedge fund factory would run a strategy trading the difference between two bonds, while simultaneously running a strategy trading short-term momentum in Asian currencies, and another trading volatility in agricultural commodities. The goal, by combining dozens of uncorrelated low-risk strategies, the firm aimed to create an overall portfolio that had a smooth, steady upward equity curve, the opposite of the fat-tail returns of pure trend following. When one strategy inevitably struggled to draw down, others would compensate, creating a highly stable, low-volatility return stream. Patterson details how the systematic pursuit of decorrelation inadvertently became the source of systemic risk, as seen in Chapter 2. As more factories, AQR, Citadel, Renaissance, adopted similar models, the very market inefficiencies they were exploiting became correlated in times of crisis, leading to the devastating unified liquidation of 2007. The complexity of the method failed to foresee the simplicity of the mass psychological panic that would unify all assets. Modern context, AI is speed in the individual. The hedge fund factory model remains the dominant force in finance today, having evolved into AI-driven hedge funds that utilize machine learning and predictive analytics. Algorithmic trading and execution speed. The speed advantage that Shaw and Simons pioneered is now a prerequisite. Algorithmic trading dictates that retail traders using a zero-commission trading app cannot compete on short time frames. The individual's lesson. The hedge fund factory proves the systematic lesson of the time factor. If you cannot beat the quants on speed, milliseconds, you must move to a time horizon where they do not dominate weeks or months. The individual's method must be structured around swing trading or position trading, where the psychological momentum of the crowd is slower and more durable. Fractional shares culture and data. The systematic approach of the quant factory dictates that all data is valuable. The retail trend of fractional shares culture and the high-frequency trading in crypto casinos provide the modern factory with more granular, high-velocity data on hyper-speculative behavior and retail FOMO. The individual trader must realize that their actions are not private. They are systematically tracked and monetized by these massive, institutional machines. The enduring lesson of the hedge fund factory is that to succeed in finance, you must stop viewing trading as an art form and embrace it as a rigorous, systematic, and repeatable business process. The focus must be on process efficiency, objective risk calibration, and a continuous search for robust strategies that survive the inevitable failures of individual models. Chapter 6. The man who tamed volatility shifts the narrative focus from the chaos of the financial markets to the intellectual battlefield of risk modeling, introducing a figure whose ideas were instrumental in both the rise and the catastrophic failure of the quants, Robert Merton. Patterson details how Merton, a Nobel laureate in economics, developed sophisticated mathematical frameworks that were designed to quantify and manage volatility, giving the quants the necessary intellectual ammunition to justify their massive leverage addiction. This chapter is a deep dive into the method pillar, examining how the mathematical tools intended to provide a systematic shield against market swings were ultimately corrupted by the God complex and used as a systematic license for taking extreme risk. The genesis of modern risk theory. Robert Merton's early work, particularly his contributions to the Black-Scholes-Merton option pricing model, for which he won the Nobel Prize, provided the foundational quantitative tools for understanding and managing risk. This model, which calculated the theoretical price of an option based on variables like time, interest rates, and volatility, fundamentally changed how financial instruments were valued and traded. Valuation by equation. Before Merton and his peers, options trading was largely speculative guesswork. Their model provided an elegant, systematic equation that allowed traders to determine the fair value of derivative instruments. This enabled the massive, organized growth of options and futures markets, which became the preferred instruments for quant strategies due to their leverage and liquidity. The concept of hedging. Crucially, the model introduced the concept of dynamic hedging, the mathematical idea that traders could perfectly offset the risk of a derivative position by continuously adjusting their position in the underlying asset. This provided the quants with a psychological and mathematical basis for believing their trades were risk-free or market-neutral, fueling their confidence to scale positions exponentially using borrowed money. The mathematical promise was seductive. Volatility was no longer a threat. It was a known variable that could be systematically tamed and exploited for profit. Long-term capital management, LTCM, and the model's hubris. Patterson uses a story of long-term capital management, LTCM, founded by Merton's colleague Myron Scholes and featuring Merton himself, as the ultimate cautionary tale of model-driven hubris. LTCM was the epitome of the quant ideal, a fun stat by intellectual titans who believed their superior mathematical method would guarantee success. The strategy. LTCM primarily engaged in fixed income arbitrage and other statistical arbitrage strategies. They use sophisticated models to find tiny pricing discrepancies between highly correlated assets, like two different government bonds that should trade similarly. They bought the undervalued one and shorted the overvalued one. The leverage. Because the expected profit on each trade was minuscule and the perceived risk was near zero due to the hedging and correlation assumptions, LTCM used extraordinary leverage, sometimes holding positions worth over $1 trillion on a few $billion of equity. The fund operated on the absolute certainty that their models could perfectly predict the narrow range of market fluctuations. The systematic failure. When Russia defaulted on its debt in 1998, the LTCM Black Swan, correlations broke down globally. Assets that were systematically pegged to move together flew apart. The fund's models, which did not account for such a widespread liquidity freeze, failed instantly. The sheer scale of their leverage addiction, justified by Merton's complex but ultimately flawed risk models, meant their losses were catastrophic and threatened the entire global financial system, requiring a massive Federal Reserve-orchestrated bailout. LTCM proved that the complexity of the method is no substitute for the simplicity of the 2% rule and the humility of the mind. The God complex led the brightest minds to believe they were exempt from fundamental money management principles. The flaw in the quant logic. Perfect markets. The fundamental flaw in the models that tamed volatility was the underlying assumption of market efficiency and continuous liquidity. Merton's models assumed that prices adjust smoothly and continuously. Hedging adjustments can be made instantly and without cost. Liquidity is always available. The Black Swan event in 1998 and later 2007 proved that in moments of extreme mass psychological panic, markets become completely inefficient. Liquidity vanishes. Prices jump wildly, discontinuously, and the ability to execute the necessary hedging adjustments disappears. The moment the models were needed most, the market conditions necessary for the models to work cease to exist. This is a vital lesson for today's systematic trader. Never assume perfect liquidity, especially when dealing with high volatility products in environments like crypto casinos or highly leveraged option gambling markets. The ability to execute a stop loss instantly is the primary defense against systemic risk. But if liquidity evaporates, even the best system fails. Modern context. AI and the volatility smile. The legacy of Merton's work continues to dominate, particularly in the realm of advanced algorithmic trading and AI-driven hedge funds. The volatility smile. Merton's models assumed volatility was constant. The market quickly revealed the volatility smile, the empirical observation that market-implied volatility is actually higher for options that are far out of the money, i.e., options that are massive bets on extreme moves. This smile is the market pricing in the inherent risk of the fat tails that the original models ignored. Systematic response. Modern quant and AI-driven hedge funds have systematically built the volatility smile into their pricing models, acknowledging that the probability of extreme black swan events is empirically much higher than theoretical models suggest. The warning for hyperspeculative behavior. The experience of LTCM serves as the ultimate warning against using complex models you don't fully understand to justify reckless hyperspeculative behavior. The Robinhood generation often utilizes simplified quantitative strategies, like specific options income trades, without understanding the core assumption risks. The quant's failure dictates that if you can't manually break down and explain the core risk of your position, your money management is flawed, regardless of the sophistication of the tool you are using. The only reliable defense remains a simple 2% rule, combined with the humility to assume your models will inevitably fail. Chapter 7. The Formula for Disaster. Chapter 7. The Formula for Disaster delves into specific, structural weaknesses within the quantitative models that were not merely wrong, but actively catalyzed the crisis of 2007 to 2008. Scott Patterson focuses on the complexity of derivatives pricing and the systemic spread of flawed mathematical assumptions, arguing that the very formulas designed to calculate risk became the unwitting blueprint for financial ruin. This chapter exposes the ethical and professional failure of the quants to account for the human element within their equations. This chapter is a profound cautionary tale about the method pillar, demonstrating that when a system's complexity exceeds the human ability to intuitively manage its risks, the complexity itself becomes the greatest vulnerability. The spread of the quant contagion, CDOs and the Gaussian copula. The central mechanism of the disaster was a collateralized debt obligation, CDO, a complex financial instrument that bundled thousands of individual loans, many subprime mortgages, into tranches of varying risk. The quants were tasked with determining the price and, crucially, the risk of these CDOs. The flawed assumption, independence. To price these massive bundles, the quants needed a formula to calculate the probability that many underlying loans would default at the same time. They relied heavily on a mathematical tool known as the Gaussian copula, which was effectively the formula for correlation. The problem: the Gaussian copula, a tool designed for simpler, less systemic correlations, fundamentally required an input of correlation, the probability that the underlying assets would move in lockstep. The quants, blinded by the perceived stability of the housing market in the early 2000s, plugged in a historically low correlation number. This assumption reflected a belief that a housing crisis would be localized, meaning if mortgages in California failed, mortgages in Florida would remain stable. The systemic error. The low correlation assumption mathematically proved that the highest, safest slices, super senior tranches, of the CDOs were virtually risk-free. This gave the quants and the rating agencies the mathematical license to rate these toxic assets as AAA. The formula for disaster was not the copula itself, but the arrogant, low-risk input that the quants, afflicted by the God complex, chose to enter into the model. The quants violated the most basic tenet of the mind pillar: garbage in, garbage out. They allowed their model to validate their preconceived narrative of safety, rather than forcing the model to test the worst-case scenarios. Complexity as a defense mechanism. Patterson argues that the complexity of the formulas, the Greek letters in the advanced calculus, served a secondary, dangerous psychological function. It masked the true simplicity of the risk. The barrier to scrutiny. The complexity of the CDO pricing models and the Gaussian copula created a massive information asymmetry. Few non-quant traders, senior bank managers, or regulators could understand the mathematics, let alone question the core assumptions. This allowed the quant to operate in an unchecked intellectual bubble, free from the common-sense scrutiny that might have questioned the leverage addiction built into the system. The illusion of intelligence. The complex math reinforced the quant's God complex, providing the psychological justification that their system was too smart to fail. This complexity was the antithesis of the simple, transparent rules that Elder insisted upon for successful trading management. The quants' formulas were fundamentally opaque and prone to systematic fragility. The formula for disaster was, in part, the institutionalized complexity that prevented the necessary systematic checks and balances from functioning. Correlation breaks and the failure of the stop-loss. The entire structure of the CDO market relied on the assumption that the correlation input was accurate. The black swan event of the housing crisis proved that the quants were wrong. When the economy entered a psychological crisis, everything correlated to one. The psychological reality. When mass psychological panic took hold, all loans became highly correlated. Everyone who had bought a house they couldn't afford, whether in California or Florida, began defaulting simultaneously. The correlation went from the quant's input of low single-digit percentages to near 100%. The stop-loss failure. Because the CDO models did not allow for possibility of 100% correlation, the systematic stop-loss built into the banking system, which relied on AAA rating, never triggered. When the defaults began cascading, the price of the safe slices plummeted instantly, leaving no time for quant's algorithmic trading to adjust positions. The speed of the collapse was overwhelming. The collapse revealed a fundamental money management failure. The quant's risk management was baked into their flawed pricing model, the copula, rather than into simple, absolute limits like the 2% rule. When the model failed, the entire risk defense failed instantly and completely. Modern context, AI and unquantified risk. The formula for disaster holds critical lessons for the modern systematic landscape. The transparency mandate for AI-driven hedge funds. Today's AI-driven hedge funds use far more complex machine learning models that operate as black boxes, often finding correlations and patterns that no human understands. The lesson from the CDO crisis is the need for transparency and robustness. If the quant of today cannot manually break down and explain the core risk assumption of their AI model, the system is fundamentally fragile. The AI must be tested against non-historical, highly correlated stress events, like a simultaneous collapse in crypto hype cycles and technology stock valuations. The hyperspeculative correlation risk. The retail trader engaging in hyperspeculative behavior must understand the danger of hidden correlation. Buying a Bitcoin ETF, holding a tech index ETF dominance, and investing in a tech-focused growth fund often means the trader is holding the same correlated risk across 3 different vehicles. If mass panic hits the tech sector, all 3 positions will plummet together, violating the spirit of diversification. The formula for disaster is believing that diversification of names means diversification of risk. The most enduring message of Chapter 7 is that the pursuit of mathematical elegance is secondary to the necessity of money management simplicity and conservative self-preservation. The professional trader must always assume the formulas are flawed and that the market, driven by powerful mass psychology, will always find a fault line in the system. Chapter 8. The Noise Traders. Chapter 8. The noise trader shifts the focus from the failures of the elite quantitative models to the psychological chaos created by the vast majority of ordinary, emotional investors. Scott Patterson uses the term noise traders, first coined by economists to describe investors who trade based on irrelevant information, rumor, or panic rather than rational fundamentals, to represent the mass psychological element that the quants sought to model but ultimately failed to control. This chapter underscores the fundamental conflict between the systematic logic of the method and the unpredictable, self-destructive behavior of the emotional mind. The quant's great error was underestimating the sheer volume and velocity of the noise generated by these traders, which often overwhelms rational price discovery. The definition of noise. In the context of quantitative finance, noise is any price movement that is not attributable to fundamental value or systematic predictability. It is the erratic, high-frequency, emotional fluctuation caused by human error, media hype, and impulsive action. The quants viewed noise as an inefficiency that could be statistically filtered out, or, better yet, exploited. Their algorithmic trading was designed to execute trades too quickly for the noise traders to affect the price before they locked in their tiny, systematic profit, alpha. The systemic reality. The collective, unified action of millions of noise traders creates massive, sustained price movements, the very trends that simple trend following captures. The quants, focus on the micro level, fail to see that when unified by FOMO or mass panic, The noise traders could generate systemic forces powerful enough to break even the most sophisticated statistical arbitrage models. The noise trader is a person who buys a meme stock because of a social media post, sells an ETF out of fear because of a headline, or engages in reckless option gambling based on a rumor. They are the market participants acting on emotion, which systematic traders, Koval and Elder, rely on as the fuel for their systems. The amplification of noise in digital markets. Patterson details how the noise trader phenomenon, originally a feature of slow, human-driven markets, was rapidly amplified by the rise of technology and democratization of trading. Zero-commission trading and velocity. The advent of zero-commission trading and easily accessible apps dramatically increased the participation rate and frequency of trading among noise traders. Increased frequency, the ability to trade instantly and for free, lowered the threshold for impulsive action. Every emotional whim, every rumor, could be immediately translated into a market transaction, increasing the velocity and volume of the noise. The psychological feedback loop. The immediate display of profit and loss on the digital trading apps created a high-frequency psychological feedback loop, amplifying greed upon a win and intensifying fear upon a loss, further fueling the emotional trading cycle. This is the day trading psychology in the 2020s, a market ruled by instant emotional gratification and pain. Social media financial panic cycles. Social media financial panic cycles provide the modern mechanism for coordinating the noise traders. A single viral rumor or post can trigger a unified, emotional buying or selling frenzy that is completely divorced from fundamental reality. The illusion of analysis. Social media gives noise traders the illusion that they're engaged in analysis, the mind, when they are, in fact, merely participating in a coordinated emotional transaction, the mass psychology. The quant blind spot. This coordinated hyperspeculative behavior, like the surge in meme stocks, is a form of collective irrationality that the quant's historical models, built on the assumption of independent irrational actors, fail to predict. The power of millions of noise traders acting in concert is a new, systemic risk the method did not account for. The quant strategy to exploit noise. Despite the dangers, the quants relied on the existence of noise traders for their profit. The very inefficiency that created the chaos was the alpha they sought to capture, arbitraging human slowness. The core strategy of the early quants was to arbitrage human slowness. Noise traders, driven by emotion, execute trades with hesitation, delay, and irrational price limits. The quant's algorithmic trading was systematically programmed to step in during these tiny windows. Liquidity provision. Quants systematically provided liquidity when noise traders were panicking, selling too low, or becoming euphoric, buying too high, capturing the bid-ask spread and the temporary mispricing caused by emotional haste. Statistical momentum. The quants exploited the psychological tendency of noise traders to chase price movements, using their complex statistical models to predict the microseconds a surge would persist before reversing. The irony is that the quant's sophisticated method became utterly dependent on predictable irrationality of the mind of the noise trader. The danger of unified noise. The Black Swan event of 2007 demonstrated the danger of underestimating the noise trader. The quants models assumed that when noise increased, their trades would either stop or be executed quickly to reduce exposure. They did not anticipate that the noise could unify and overwhelm the very liquidity they relied upon. Liquidity evaporation. When the systemic crisis hit, the noise traders, along with institutional players, began selling everything out of mass panic. This unified, indiscriminate selling caused liquidity to dry up, preventing the quants' algorithmic trading from executing their complex hedging strategies. The amplification effect. The noise, amplified by social media and rapid execution, became a macro force that destroyed the micro-assumptions of the quant models. The complexity of the quant method proved useless when faced with the sheer volume of fear-driven selling. The lesson for the systematic trader is clear. The money management pillar must be designed not just to survive individual losses, but to survive periods when the collective noise is so intense that the market temporarily ceases to function rationally. The noise trader is not just a source of profit. They are a source of systemic risk. Chapter 9, The Volatility Trap. Chapter 9, The Volatility Trap is a critical examination of the method and money pillars, focusing on how the quant attempted to tame volatility, the measure of market fluctuation, and how this very attempt led to their systemic undoing. Scott Patterson details the rise of quantitative volatility trading and the subsequent realization that volatility is not a stable, predictable input for a model, but a dynamic, often self-reinforcing psychological force that actively works to destroy the assumption of certainty. The volatility trap is the illusion that complex mathematics can transform an unpredictable, chaotic force into a manageable, exploitable variable. The chapter shows that the quants' failure lay in their God-complex assumption that they could control what is inherently uncontrollable. The allure of volatility trading. For the quants, volatility was not just a risk factor. It was a massive, tradable asset class. Volatility tends to cluster. Periods of high volatility are often followed by more high volatility, and vice versa. This predictable clustering provided a clear, systematic alpha source. The VIX and the Fear Index. The creation of the VIX Volatility Index and its associated derivatives allowed quants to make systematic bets directly on the market's anticipated level of fear or complacency. They built models to predict whether the market was due for a period of low or high volatility, using futures and options contracts to exploit the difference between implied, expected, and realized actual volatility. The strategy, often, quants would systematically sell volatility, sell options, because statistically, implied volatility tend to be higher than realized volatility. This strategy offered a steady, positive income stream in normal markets, but carried the massive, asymmetric risk of a black swan event, where volatility would spike suddenly and violently, making the losses catastrophic. This strategy was the ultimate expression of the money management flaw, chasing a small, steady income to carry trade, in exchange for a tiny probability of a total loss. The steady income reinforced the mind's confidence, making the ultimate failure psychologically devastating and financially total. The problem of liquidity and correlation. The volatility trap was sprung in 2007 because the quants models relied on the assumption of continuous liquidity to manage their complex, volatility-driven hedges. The systematic hedge. To manage the risk of selling volatility, quants use complex, algorithmic trading to dynamically hedge their positions. This involved constantly adjusting their holdings in the underlying assets as volatility fluctuated. Liquidity evaporation. When the systemic crisis began, liquidity vanished from the market. The quants' algorithms, programmed to execute hedges instantly, suddenly found that the buyers and sellers they needed disappeared. They couldn't execute the trades required by their models. The method was rendered useless because the market conditions necessary for its operation ceased to exist. The volatility spike. Furthermore, the correlation between assets broke down, and their exposure to volatility, which they thought was hedged, soared. The simultaneous, unified mass psychological panic caused volatility to spike to historic highs, while the ability to hedge was zero. The entire volatility trading sector became paralyzed, accelerating the crash as they were forced to liquidate their remaining positions. Patterson shows that the volatility trap was the failure of the quants to recognize the fragility of their own models when faced with human panic. They treated volatility as a mathematical constant when it was, in reality, a psychological variable amplified by systemic fear. Volatility in the modern context. The VIX and crypto. The lessons of the volatility trap are critically important for the modern systematic trader facing decentralized markets and high leverage. The hyperspeculative VIX trading. Today's retail trader, often engaging in hyperspeculative behavior via zero-commission trading apps, frequently trades instruments tied to the VIX itself. These products are highly vulnerable to the exact same liquidity crisis the quants faced. The trap. Trading inverse VIX products, which profit from sustained low volatility, offers the illusion of steady gains but risks total capital destruction during a sudden black swan spike. The professional trader, adhering to elders' money management principles, must assume the probability of a massive VIX spike is far higher than historical data suggests. The 2% rule must govern any high-risk volatility exposure. Volatility in Bitcoin bubbles and option gambling. The market for Bitcoin bubbles and aggressive option gambling is a market defined by extreme, non-linear volatility. Quantifying the unquantifiable. The price swings in crypto casinos are often 10 to 100 times greater than those in traditional assets. The method must systematically account for this. Elders' use of the average true range, ATR, to calculate position sizing is the only safe defense. A systematic trader must use a high volatility input to drastically reduce the unit size traded, ensuring the dollar loss remains capped at 1% or 2% of capital. The psychological cost, the constant high volatility in these markets acts as a relentless stress test on the mind. The volatility trap is that the high potential reward seduces the trader into violating the money management rules, believing they can handle the risk, when in reality, the sheer psychological noise of the price swings ensures they will fail to execute their system flawlessly. The ultimate takeaway from the volatility trap is humility. Volatility cannot be tamed by code. It can only be survived by conservative, simple, and unyielding risk control that assumes the market will always move against a position in the most extreme, unpredictable way possible. Chapter 10. The Revenge of the Analysts. Following the harrowing failure of the complex mathematical models during the Black Swan event, Chapter 10. The Revenge of the Analysts details a temporary, yet crucial, return to prominence of a traditional, fundamental-driven Wall Street trader. Scott Patterson chronicles a period immediately following the 2007 to 2008 crisis, when the very models that promised certainty were proven fallible, triggering a deep psychological crisis within finance and creating a brief window for the old guard to claim victory. This chapter underscores a powerful psychological lesson. When complexity fails catastrophically, simplicity and common sense regain trust. It was a momentary reversal of the systematic trend, proving that human intuition and subjective judgment still hold sway when machine certainty is shattered. The crisis of confidence in code. The financial crisis was, fundamentally, a crisis of faith in mathematics. The entire structure of modern finance, from derivative pricing to value-at-risk VAR calculation, had been delegated to the quants, who promised that their sophisticated code provided a systematic shield against systemic risk. When the system failed, the subsequent collapse of long-term capital management, LTCM, and the near failure of major banks due to their quant-derived holdings exposed the hubris of the God complex. The psychological retreat. Investors who had poured billions into quant funds suddenly pulled back. The complexity that once signaled genius now signaled danger. Money fled opaque, highly leveraged algorithmic trading strategies in favor of transparent, human-managed funds. The victory of narrative. The market demanded simple answers. It was easier to trust a traditional analyst who could break down a company's balance sheet and offer a coherent narrative than to trust a physics PhD whose explanation involved complex differential equations and Six Sigma events that no one could visualize. This temporary shift validated the power of the mind to crave narrative and simplicity over complex, flawed mathematics. This market reaction temporarily empowered the discretionary trader. Their subjective judgment, which the quants had dismissed as noise, suddenly became an asset because it was perceived as prudent and understandable, fulfilling the core psychological need for control during chaos. The quants' vulnerability, liquidity, and correlation. The revenge of the analysts was fueled by the quantitative model's most critical structural flaw, the failure to account for the evaporation of liquidity and the breakdown of correlation during mass psychological panic. The analyst's edge. The traditional analysts did not rely on hedge models. They relied on their own intuition regarding supply, demand, and market sentiment. They understood that in a true crisis, all systematic hedges fail, and the only certainty is a desperate flight to quality. While they couldn't model the crash, they could instinctively react to the human desire for safety. The systematic betrayal. The quant highly leveraged strategies were systematically programmed to liquidate when correlations broke. This forced selling by the algorithmic trading networks created the very buying opportunity the fundamental analysts and discretionary traders were waiting for. They were able to step in and buy assets at fire sale prices, often from the paralyzed quant funds that were being forced to sell at any cost to maintain their rigid, coded risk ratios. This was the perfect illustration of the volatility trap. The quant's tools designed to manage volatility instead became slaves to it, while the discretionary traders were free to apply Elder's money management rule, the calmness and patience to wait for the emotionally driven mispricing. The modern echo, meme stocks and fundamental value. The revenge of the analysts is mirrored today in the ongoing debate over meme stocks and crypto hype cycles. The failure of quant shorts. The initial surge in meme stocks was a financial shockwave that proved the inadequacy of models built solely on fundamental analysis. Any systematic quant model that shorted a stock based on poor earnings or high debt was financially destroyed by the coordinated, irrational FOMO of retail investors. The fundamental counterargument. The analysts and value investors who ignored the hyperspeculative behavior and stuck to fundamentally sound businesses survived the volatility and eventually profited. They proved that while fundamental analysis is useless for timing the market, Koval's lesson, it remains the ultimate shield against over-leverage and unsustainable risk in the long term. Patterson's lesson here is that fundamental analysis is a crucial, if simple, risk filter. It may not tell you when to buy, but it tells you what to avoid, specifically assets whose price has become so divorced from intrinsic value that the risk of a catastrophic, unpredictable collapse is immense. The systematic trader must use fundamentals as a final psychological check on the greed inherent in following any trend, no matter how strong. The return of the machines. However, the revenge was short-lived. The fundamental analyst's success was largely attributable to the massive, temporary mispricings created by the quant collapse. Once liquidity returned and assets stabilized, the quants rapidly regained their systematic edge. The data advantage. The quants learned from the black swan. They built new models that factored in the probability of correlation breakdown and liquidity freezes. They didn't abandon the method. They debugged it, incorporating the systemic failures into their code. The structural advantage. The underlying structural advantage, speed, computing power, and the ability to execute millions of trades flawlessly, remain with the machines. No discretionary trader, no matter how brilliant, could consistently outperform the systematic execution of a refined algorithmic trading network. The ultimate lesson of the revenge of the analyst is not that human judgment won, but that human judgment is required to fix the models when they fail. The synthesis of the modern systematic trader is the combination of the quant's relentless method with the analyst's money management humility, a system that is mathematically rigorous but always conservatively managed, assuming the human element will eventually cause the code to break. Chapter 11. The Secret of Man versus Machine. Chapter 11. The secret of man versus machine stands at the philosophical heart of the quants, confronting the enduring question that defines the modern financial era, which is superior, the emotional judgment of the discretionary trader or the cold, systematic logic of the machine? Scott Patterson moves beyond the failure of complex models and delves into the psychological and intellectual synthesis required for success, arguing that the true secret lies not in choosing one over the other, but in integrating the strengths of both while mitigating their respective flaws. This chapter serves as the ultimate bridge between the mind and method pillars, revealing that the successful systematic approach must utilize the machine for execution and the human for design and risk management. The unassailable strength of the machine. The quants prove definitively that the machine possesses several advantages that no human trader can ever match, making the total elimination of algorithmic trading impossible in the modern market. Speed and execution. The machine operates at the speed of light, processing data and executing trades in milliseconds. It eliminates slippage and captures tiny market inefficiencies, micro-alpha, that are invisible to the human eye. The discretionary trader is hopelessly slow when competing on these short time factors. Emotional immunity. The machine is perfectly immune to the psychological flaws that destroy human traders. It does not feel FOMO during a Bitcoin bubble. It does not freeze from fear during a flash crash, and it does not violate the position sizing rule due to greed. It executes the method flawlessly, without discretion. Data processing and pattern recognition. Machines can analyze millions of data points across global markets simultaneously, finding complex, nonlinear correlations that would take a human thousands of years to calculate. This capability allows quants to identify subtle statistical arbitrage opportunities across diverse asset classes. The systematic trader's edge, therefore, must be to delegate execution to machine wherever possible, acknowledging its superior speed and emotional purity. The irreplaceable role of man. Patterson argues that while the machine is superior at executing the trade, the human remains essential for two critical, non-quantifiable functions that code cannot replicate: design and intuition. The initial idea for a systematic trading strategy, the spark of insight that identifies a market inefficiency, still originates in the human mind. The machine only executes the rules given to it. Furthermore, the human mind possesses intuition and the capacity for lateral thinking, the ability to identify a black swan event that exists outside of the historical data set. The failure of the quants was not the code itself, but the human God complex that believed the code was flawless. Risk management of the unknown. This is the most critical human role. The human is responsible for setting the conservative, absolute limits that protect the system when the code inevitably encounters a market condition, a correlation break, or liquidity freeze, that its historical data was not trained on. The machine is programmed to execute, but only the human can define the maximum allowable loss and the ultimate emergency shutdown rule, Elder's 6% rule. The secret, therefore, is not man versus machine, but man over machine, using human intuition and humility to impose absolute money management control over the machine's execution capabilities. The synthesis, systematic humility. The synthesis that emerged from the 2007 to 2008 crisis was a refined, more humble systematic approach that integrated the best of Koval, Elder, and the quants. Human for system design. Mind the trader must design the system with the humility to assume it will fail. The system must include systematic stress tests that assume asset correlations will collapse and liquidity will evaporate, forcing the method to be robust in the face of psychological chaos. Human for risk control. Money the absolute position sizing rules, the 2% rule, must be set by the human, based on conservative principles, not by a complex VAR model that might underestimate risk. The risk must be defined absolutely, not probabilistically. Machine for execution. Method the entry and exit signals, once defined, must be executed by the machine to eliminate the emotional errors of the noise trader, the procrastination, the hope, and the greed. The machine is the perfect servant to the human's risk mandate. This synthesis addresses the flaws of both systems. It harnesses the machine's power while protecting the overall capital base from the machine's inherent blind spots. Modern context. AI and the financial influencer. The debate of man versus machine is more acute than ever with the rise of AI-driven hedge funds and machine learning models. The AI black box. Modern AI models are often black boxes, finding patterns that are too complex for human understanding. Patterson's lesson warns that the systematic trader must never risk more than the 2% rule on an AI model, whose core assumptions cannot be manually broken down and explained. The risk of the unknown remains, and the only defense is capital protection. The emotional pitfall of the financial influencer. The human element manifests in the retail world through the financial influencer and the chaos of social media financial panic cycles. When the market is moving, the human tendency is to seek external validation noise rather than adhering to the system. The systematic trader must view the output machine, the flawless execution of their own code, as the only permissible external validation, protecting the mind from the emotional contamination of the crowd. The secret of man versus machine is that the machine is the better trader, but the human is the better risk manager. Systematic success requires the discipline to let the machine do what it does best, execute quickly, while reserving the ultimate power, the power to say stop, for the human mind. Chapter 12. The Quiet Crisis. Chapter 12. The Quiet Crisis chronicles the terrifying, almost invisible period in the summer of 2007 when the quantitative financial system first started to crack. Scott Patterson details how the failure was not announced by a massive, sudden crash, but by a series of quiet, technical malfunctions and unprecedented losses in complex funds. This crisis was invisible to the public, occurring solely within the realm of mathematical code and automated algorithmic trading, making it a chilling testament to the systemic fragility the quants had built. This chapter serves as a stark warning about the danger of model risk and the crucial importance of the money management pillar. Specifically, the need for human oversight to recognize and react to technical failures that the models themselves cannot diagnose. The unseen fracture. Code breakdown. The core of the quiet crisis was a breakdown of the most sophisticated quant strategies, statistical arbitrage, and other complex, highly leveraged systems designed to exploit tiny, fleeting market inefficiencies. Correlation breaks down. The crack began when the underlying assumption of quant models, that certain asset statistical pairs, would maintain a stable, non-correlated relationship, started to fail. As early stress in the subprime mortgage market intensified, assets that should have moved independently began moving in lockstep, often in directions that triggered simultaneous losses on both the long and short sides of the hedge positions. The model's blindness. The models were programmed to calculate risk based on historical volatility, but they were not programmed to detect a fundamental change in market regime, a black swan event. They continued to signal that the risk was manageable, even as real-time losses mounted. The quants, afflicted by the God complex, trusted the code over the accumulating losses. The speed of collapse. Because the funds were built on immense leverage addiction, these unpredicted losses, though small individually, were magnified exponentially. The sheer volume of automated selling triggered by initial margin calls overwhelmed the thin liquidity in the micro markets the quants relied upon, turning a technical error into a catastrophic financial loss. Patterson details how this quiet period was defined by quants staring at screens, watching their code fail for reasons they could not immediately isolate. The sophisticated method was working perfectly, but its core assumptions about human behavior and market stability were proving disastrously wrong. The problem of unified liquidation. The quiet crisis quickly escalated due to the quant's systemic failure to account for unified liquidation. The herd of machines. When the correlation broke, the algorithmic trading networks, run by different quant firms, Renaissance, AQR, Highbridge, all received similar signals simultaneously. Risk has spiked, liquidate positions. Since they were all trading the same assets based on similar models, they all tried to sell at the exact same moment. Liquidity evaporation. The market was suddenly flooded with massive, unified selling pressure that no one anticipated. Liquidity, the ability to buy or sell an asset quickly without affecting its price, vanished. The quant stop-loss orders, which were supposed to provide instantaneous protection, could not be executed at the desired price, resulting in massive, unexpected slippage and deeper losses. The feedback loop. This program panic created a self-reinforcing loop. Forced selling drove prices down, which triggered more margin calls, which necessitated more forced selling. The machines, designed to be emotionless, accelerated the very mass psychological panic that the human traders eventually reacted to. The crisis proved that systematic adherence to code is only as good as the least common denominator. If everyone's code is based on the same flawed assumptions, they will all fail together. The human response, failure of the mind. Patterson details the crucial failure of the mind during the quiet crisis, the inability of human managers to override the code when necessary. Paralysis by complexity. The models were so complex that when they broke, the quant managers were paralyzed. They couldn't diagnose the problem quickly enough to intervene, fearing that a hasty, discretionary intervention would make the system worse. Their trust in the math, the God complex, was absolute, overriding their common sense. The delayed exit, the failure to execute Elder's core principle, cut losses instantly, was not due to fear, but due to intellectual arrogance. The quants believed the market was making a temporary, irrational mistake that their models would quickly correct. They held positions, convinced the math would prevail, turning controlled losses into catastrophic ones. This moment highlights the critical need for human oversight. The Synthesis of Man over Machine, Chapter 11. A systematic trader, even running a complex model, must have a non-negotiable, human-imposed emergency shutdown rule, like the 6% rule. The moment system losses reach an established, conservative threshold, the human must override the code and halt all trading, protecting the money pillar from the failures of the method. Modern context, AI and the flash crash. The lessons of the quiet crisis are the foundation of understanding modern market instabilities, like the 2010 flash crash. The persistence of algorithmic fragility. Today's AI-driven hedge funds and algorithmic trading networks are exponentially faster and more complex, but the underlying vulnerability, the potential for unified liquidation due to shared assumptions, remains. This creates systemic risk across assets, including ETF dominance indices, where sudden, coordinated selling can trigger massive, temporary price dislocations. The warning for retail. For the Robinhood generation engaging in hyper-speculative behavior and cheap leverage through technology, The quiet crisis is a warning that market volatility can manifest without warning and without human explanation. The only protection is the absolute conservatism of the money management rules. Never risk so much that a sudden, unpredicted liquidity freeze, where stop losses fail to execute at the desired price, can destroy your account. The risk of sudden, invisible failure is permanently embedded in the market. Chapter 13. The Machine Breeds Disaster. Chapter 13. The Machine Breeds Disaster moves a narrative beyond the initial quiet crisis, Chapter 12, and chronicles the systemic, self-inflicted wounds caused by the quant's unchecked use of technology and leverage addiction. Scott Patterson details how the very machines designed for optimization and efficiency became the unstoppable engine of catastrophe, proving that the algorithmic trading network was inherently designed to amplify, not dampen, mass psychological panic. This chapter provides the ultimate case study in the failure of the method when divorced from conservative money management, showing how the pursuit of mathematical perfection creates systemic, nonlinear risk. The unintended consequence of optimization. The quants built their systems for optimal efficiency, to execute trades faster, to hedge more precisely, and to deploy capital with maximum leverage. This optimization, however, created a system that was robust to minor fluctuations but fatally fragile to extreme shocks. The fragility of efficiency. In a complex system, efficiency often comes at the cost of redundancy and safety. The quant systems removed all buffers and safety margins in the pursuit of maximizing return on equity. When a black swan event occurred, there was no built-in slack, no redundant capital, no unhedged positions to absorb the shock. The method was pushed to its absolute limit, leaving no margin for error. The shared strategy problem. The core disaster was that hundreds of AI-driven hedge funds were optimized for the same market conditions and were programmed to execute similar defensive strategies. Their optimization was based on the assumption that they were operating independently. When the crisis hit, their unified, optimized response, instantaneous liquidation to manage risk, created a massive, systematic force that triggered a liquidity freeze and accelerated the market's collapse. Patterson shows that the machine did not fail because its code was wrong. It failed because its code was too right in the wrong environment, perfectly executing its program logic at the exact moment that logic was guaranteed to create a global catastrophe. The amplification of panic. Code as contagion. The machine's role in breeding disaster was its ability to accelerate and amplify the psychological withdrawal of capital, the equivalent of Elder's mass psychology running at light speed. Speed of contagion. When the models began signaling unpredicted losses due to the breakdown of correlation, the algorithmic trading systems did not pause to analyze the news or consult a financial influencer. They executed their risk reduction mandate instantly. The speed of the machine ensured that the fear, the risk signal, spread across the entire financial system in seconds. This was the market equivalent of a computer virus, multiplying the initial error exponentially. Forced selling and feedback loops. The forced selling required by the quant's program stop-loss rules, triggered by their complex, failing VAR models, was so immense that it drove asset prices far below their fundamental value. This created a systematic feedback loop. Low prices triggered more margin calls, which triggered more forced selling, until the human element, the institutional clients, were forced to intervene manually. The collapse of hedging. The quant's highly leveraged derivatives, designed for intricate hedging, required constant rebalancing. When the market moved violently, the complexity of the machine required massive, instantaneous trading to maintain. The hedge. But because the hedge required trading in the liquid, panicking market, the system became trapped, forcing the quants to become the largest, most aggressive sellers at the very bottom of the market. The method bred disaster by institutionalizing leverage addiction and then using its speed advantage to ensure the resulting crash was simultaneous and overwhelming. The failure of human accountability, the mind, the ultimate disaster bred by the machine, was the failure of accountability. The complexity of the models and the speed of execution created a distance between the human manager and the trade itself. Complexity as the excuse. The God complex provided the intellectual arrogance, but the complexity provided the psychological shield. When the trades failed, the quants could legitimately claim they didn't know why the specific position failed, only that the complex, multi-factor model had dictated the trade. This reduced the human capacity for money management because accountability was diffused into the code. The human oversight failure. Patterson shows that the human leaders of the hedge fund factories failed to impose the simple, absolute risk constraints required by Elder. They allowed the probabilistic risk defined by their models to supersede the absolute risk demanded by the 2% rule. Had the human manager simply enforced a rigid, low-leverage cap based on actual historical volatility rather than model-predicted safety, the systemic disaster would have been averted. The machine bred disaster because the human mind, seduced by the precision of the code, abdicated its final, non-quantifiable responsibility, the conservative preservation of capital against all unforeseen eventualities. Modern context, AI, and unpredictable interactions. The machine continues to breed potential disaster in the modern era, particularly as AI-driven hedge funds become more complex. Unpredictable AI interactions. The risk today is not just shared assumptions, but the unpredictable interactions between different AI models trained on diverse, nonlinear datasets, e.g., sentiment analysis, social media trends, satellite imagery. A failure in one AI system could trigger a reaction in another, creating a cascade of unexpected outcomes that no human has modeled. The retail warning. For the retail systematic trader, the lesson is to assume the machine is inherently fragile. When engaging in hyperspeculative behavior or using cheap leverage through technology, the trader must recognize that the entire system is vulnerable to instantaneous, automated failure. The only defense against the machine's catastrophic efficiency is conservative, human discipline to trade small, adhere to the stop loss, and preserve the capital needed to survive the next algorithmic flash crash. The machine is guaranteed to fail spectacularly. The successful trader is the one who is not positioned to be its victim. Chapter 14. The Treasury Secretary's Visit. Chapter 14. The Treasury Secretary's Visit chronicles a dramatic, real-world collision between the opaque world of quantitative finance and the highest levels of government. Scott Patterson details the desperate meeting in August 2007 when the systemic crisis, which began as a quiet crisis, Chapter 12, in the code of the AI-driven hedge funds, finally became so severe that it demanded the urgent attention of the U.S. Treasury Secretary. This chapter serves as the ultimate proof of the quants' impact. Their failure was not just financial. It was a threat to global economic stability. This event was a stark realization that the complexity and leverage addiction built into the quant system meant that when the method failed, the resulting problem was too vast for the market to solve itself, requiring intervention from the ultimate authority. The unthinkable, systemic risk. The Treasury Secretary's involvement signaled that the crisis had moved beyond individual fund failures to systemic risk, the potential for failure of one institution to trigger a chain reaction that could collapse the entire financial system. The quiet, coded collapse had become a looming global catastrophe. The scale of the problem. The funds failing were not small, discretionary operations. They were massive, highly interconnected algorithmic trading networks. Their forced liquidation, driven by simultaneous stop-loss triggers across hundreds of funds, the herd of machines, was so enormous that it was actively destabilizing the market for assets far beyond the subprime mortgages that initiated the problem. The unseen contagion. The most terrifying aspect was the unseen contagion. Because the quant systems were complex, opaque, and highly interlinked through derivative contracts and short-term funding repo markets, no one, not even quants themselves, could perfectly map the cascade of failures. This lack of transparency, enabled by the complexity of the method, terrified the government officials, as they could not gauge the true extent of the risk. The crisis proved the failure of the quants' God complex, the mathematical belief that they could perfectly contain and model risk. The government was suddenly forced to manage a crisis rooted in equations they didn't understand, caused by models that had been deemed risk-free. The quants' capitulation. Patterson details the palpable sense of panic and capitulation among the quant leaders during the meeting. These brilliant minds, who had dismissed traditional finance as primitive, were now begging for discretionary intervention from the very authorities they had sought to transcend. The need for human discretion. The crisis demonstrated that the quant systematic method had failed, and only a human, discretionary intervention could solve the problem. The market needed someone to step in, buy the collapsing assets, and restore liquidity. This action, an injection of arbitrary human-backed capital, was the antithesis of the quant systematic, rule-based philosophy. The failure of liquidity. The core problem the quants faced was a complete evaporation of liquidity, which rendered their complex hedging strategies and their automated stop-loss mechanisms useless. The government's role was to be the buyer of last resort, providing the liquidity that the market's internal algorithmic trading had destroyed. The end of certainty. The leaders of the quant revolution were forced to admit that their models were not perfect, that the market was not stable, and that the financial systems they created were dangerously fragile. This moment was the ultimate psychological failure of the mind pillar, marking the systematic end of belief in absolute mathematical certainty. Intervention and moral hazard. The Treasury Secretary's visit led to an unprecedented, coordinated effort by major Wall Street banks to inject liquidity and prevent the total collapse of the quant sector. This swift intervention, however, introduced the ethical dilemma of moral hazard. Bailing out the code. By coordinating the intervention, the government and the banks were essentially bailing out the flawed models and the leverage addiction that drove the quant's behavior. This set a dangerous precedent, that firms could take excessive, systemic risk, knowing that if the risk materialized, they would be deemed too big to fail and rescued by the taxpayer. The unaddressed flaw. The intervention focused on managing the symptoms, lack of liquidity, but did not immediately address the root cause, the method's reliance on flawed VAR models and excessive leverage. This failure to fundamentally repair the systematic flaws meant the same problems, built on the same overconfident assumptions, the God complex, would resurface later with even greater force. Modern context. ETF dominance and systemic liquidity. The lessons from the Treasury Secretary's desperate visit are critical for understanding systemic risk today, particularly in the context of ETF dominance and retail participation. Liquidity risk in passive vehicles. Today, millions of retail investors are systematically allocated to the market via ETFs. While this disperses risk on paper, it creates massive, correlated holdings. The modern quiet crisis risk is that during a mass psychological panic, a wave of coordinated retail and institutional selling could overwhelm the liquidity of the underlying assets. The systemic risk is no longer just complex derivatives, but the sheer size and uniformity of ETF dominance. The unquantified stress. The quant's crisis was rooted in the failure to model a liquidity freeze. Today, the retail systematic trader, engaging in hyperspeculative behavior and option gambling, must realize that their small, individual risk is magnified by this potential systemic failure. If a crisis causes liquidity to vanish, even the simplest stop loss will fail to execute at the desired price, causing larger, unpredicted losses. The ultimate application of the money management pillar is recognizing that during a systemic crisis, no market is truly safe, and the only real defense is conservative position sizing, the 2% rule, that assumes a large slippage cost. The visit of the Treasury Secretary to the quant funds marked the end of the market's innocence, proving that the machines of finance had grown too powerful to be allowed to fail, but too complex to be fully controlled by their human creators. Chapter 15. The Quant Crash. Chapter 15. The quant crash details a moment the quiet, technical crisis of 2007 erupted into a terrifying, unified, and visible collapse that shocked Wall Street and exposed the systemic fragility of the quantitative revolution. Scott Patterson describes the dramatic days in August 2007 when the sophisticated algorithmic trading strategies, previously viewed as the pinnacle of risk control, simultaneously plunged, causing massive losses and forcing the quant funds into the largest, most coordinated liquidation event in decades. This chapter is a climax of the book's initial narrative, representing the ultimate, spectacular failure of the method when the underlying assumptions about market stability, the very foundation of the God complex, were proven false. The moment of correlation break. The quant crash was triggered not by external economic news, but by a sudden, violent breakdown of correlation within the complex trading models themselves. The unthinkable signal. The quant funds, built on statistical arbitrage, relied on the historical tendency of certain asset pairs, e.g., a stock and its futures contract or two similar company stocks, to maintain a stable, predictable relationship. In early August 2007, the models began to see unprecedented, simultaneous losses on both the long and short sides of these paired trades. This meant the foundational assumption of their entire method, that their positions were market neutral and hedged, was collapsing. The systemic dominoes. As the losses mounted, the failing value-at-risk VAR, models of these highly leveraged funds began triggering mandatory risk reduction protocols. Because these funds were optimized with immense leverage addiction and minimal cash reserves, they had no choice but to sell their most liquid, non-failing assets to raise capital. The uniform response. Since hundreds of AI-driven hedge funds were running similar quant strategies, all chasing the same statistical alpha, they all attempted to sell the exact same liquid assets at the exact same moment. This created the massive, unified selling pressure that overwhelmed the market. Patterson details how this was not a human panic, but an automated panic. The logical, coded response of machines that simultaneously recognized a fatal flaw in their shared assumptions. The liquidation was driven by code, not by fear, but it had the exact same devastating effect as mass psychological panic. The liquidity black hole. The collapse was amplified exponentially by the immediate and total evaporation of liquidity. The speed of contagion. The speed of algorithmic trading ensured that the systemic risk spread across the market in minutes. The quants forced selling was so aggressive and unified that there were suddenly no buyers left. The bid-ask spread widened violently, and the price of assets plummeted far below their intrinsic value. Stop-loss failure. Slippage, the systematic trader's most vital defense. The stop-loss failed spectacularly. The programmed stop-loss order would trigger, but because there were no buyers, the order could not be executed at the desired price. Instead, it was executed at the next available price, which was often drastically lower. This slippage turned predicted manageable losses, based on the 2% rule, into unpredicted catastrophic losses, accelerating the drawdown and triggering further margin calls across the interconnected network. The human paralysis. Discretionary traders and institutional leaders were paralyzed, unable to intervene because the chaos was unfolding too quickly, and the prices were completely disconnected from fundamentals. The very speed and complexity the quants relied on became the systemic barrier that locked everyone else out of the market. The quant crash was the moment the method proved itself too fast and too interconnected to be safely managed by human capital or traditional market structure. The psychological aftermath. The end of certainty. The psychological damage from the quant crash was immense, fundamentally shattering the intellectual arrogance of the God complex. The loss of faith. The crisis proved that the most complex mathematical systems were vulnerable to the simplest of failures, the human element. The quants were forced to admit that their elegant models were just simplified representations of reality, not reality itself. The market was indeed ruled by fat tails, unpredictable behavior, and black swan events that defied their formulas. The triumph of survival. The systematic traders who survived, the turtle-style trend followers, and the few quant funds that adhered to absolute, conservative money management, like minimal leverage and strict position limits, were the only ones positioned to survive. Their survival was a victory of the mind's humility over the method's hubris. Modern context. Systemic risk today. The lessons of the quant crash are the permanent foundation of modern risk management. Algorithmic herd. The risk of the algorithmic herd remains high today, particularly in fast-moving sectors like crypto hype cycles. If an AI-driven hedge fund using sentiment analysis to trade Bitcoin bubbles suddenly detect a unified sell signal, its massive, unified liquidation could trigger a market flash crash that wipes out retail positions. ETF dominance and correlation. The sheer size of ETF dominance means that if a future crisis causes liquidity freeze, the market's response will be uniform, a massive, correlated selling wave, exactly like the one that caused the quant crash. The discipline for retail. For the Robinhood generation, the quant crash serves as the ultimate warning against leverage addiction and option gambling. The professional trader must assume that in the next crisis, stop losses will fail to execute cleanly and slippage will be immense. The money management rule must therefore be conservative enough to assume that the actual loss will be 3 or 4 times the predicted loss, ensuring that even systemic failure does not lead to an account wipeout. The only safety is the initial, ultra-conservative position sizing. Chapter 16, New Game, New Rules. Chapter 16, New Game, New Rules serves as a final, reflective chapter of Scott Patterson's narrative. examining the transformative lessons learned from the quant crash, and outlining the fundamental shifts required for the survival and success of systematic trading in the post-crisis era. The chapter argues that the period of mathematical certainty and the God complex is over. The new game demands humility, robustness, and the rigorous incorporation of human psychological risk into the method. This chapter is the ultimate synthesis, showing how the systemic failure of complexity validates the simple, conservative mind and money management principles championed by Koval and Elder. The end of the God complex. Systemic humility. The primary new rule established by the crash was a necessity of systemic humility. The belief that complex formulas could eliminate risk was proven false. The new truth is that risk is always present, and models are always flawed. Risk is nonlinear. The market proved that VAR and other models built on historical data fundamentally underestimate the probability and impact of black swan events and fat tails. The new rule is to operate with the conservative assumption that the maximum loss predicted by the model will be significantly exceeded in a crisis. The new mandate for AI-driven hedge funds and algorithmic trading is robustness over optimization. Systems must be designed with redundancy and slack, prioritizing survival and low leverage over maximizing return on equity. This means building in capital buffers that exceed regulatory minimums and maintaining positions small enough to withstand a total failure of the model's core assumptions. The human veto. The new structure demands that the human element, mind, must have the clear, absolute authority to override the machine. The complexity of the method must be subservient to the simple money management principle. When system losses hit the absolute, conservative limit, Elder's 6% rule, the human must pull the plug, regardless of the code's protest. The new game acknowledges that the best systematic system is one that is designed to survive when its own core logic is collapsing. New rules for the method, robustness over optimization. The quant crash mandated a fundamental redesign of the method, shifting away from the pursuit of fleeting micro-alpha toward strategies that are durable and robust against systemic shocks. Modeling correlation breakdown. The new rule for quant strategies is to explicitly model and stress test for the breakdown of asset correlation, instead of assuming assets are independent. The models must assume that during crisis, all assets will become highly correlated and illiquid. This forces the systems to trade smaller and maintain larger cash buffers. Focus on structural trends. The failure of short-term statistical arbitrage led to a renewed respect for simpler, long-term, directional systematic trading, like the turtle's revenge. Strategies that exploit large, sustained psychological trends, trend following, are inherently more robust because they are designed to profit from volatility and chaos, not to hedge it away. Liquidity as risk. Liquidity is now treated as a dynamic, volatile variable, not a constant. Systems must be programmed to automatically reduce exposure to illiquid assets and widen stop-loss tolerances during periods of market stress. When volatility spikes, anticipating the massive slippage and price dislocation seen during the crash. The method's new rule is to always prioritize the ability to exit a trade cleanly over the potential size of the profit. New rules for the modern trader. The new game and new rules apply directly and urgently to the modern retail trader engaging in hyperspeculative behavior and digital trading. The ultra-conservative money management mandate. The single most important rule learned from the quant crash is the need for ultra-conservative position sizing. When engaging in high-risk markets like crypto hype cycles or option gambling, the retail systematic trader must assume the risk is far higher than the market suggests. If the professional quant assumes losses will be 5x the predicted VAR, the retail trader must assume that the actual loss will be 10x the calculated loss due to leverage and digital execution speed. The only defense is to trade so small, well below the 1% rule, that even a massive, unpredicted liquidation event cannot wipe out the account. The anti-correlation check. The new rule is to constantly check for hidden correlation. If you're long an ETF dominance fund, long a sector-specific mutual fund, and long the related futures, you have zero diversification. The systematic trader must actively seek assets that are truly non-correlated, using the logic of the triple screen system across disparate markets, commodities, currency, bonds. The Robinhood generation systemic risk. The Robinhood generation must understand that their individual trading choices, when amplified by zero-commission trading and social media, contribute to the overall systemic fragility. the noise trader effect. The only moral and financial course of action is to manage their own risk flawlessly, preventing their individual failure from contributing to the next wave of mass psychological panic. The post-crisis financial world is defined by this new contract. The market is inherently unstable. The models are inherently flawed, and the only path to systematic success is through continuous humility and unyielding discipline toward capital preservation. The ultimate rule is to always manage a trade as if a black swan event is scheduled for tomorrow. Modern context expansion. The crisis of 2007 to 2008, documented by Scott Patterson, was a quantitative equivalent of a massive system debug. The method was exposed, the money management was proven insufficient, and the mind's intellectual arrogance was shattered. Today, the world of finance operates under the new rules, Chapter 16, fundamentally defined by the lessons of the quant crash. This section explores how the core principles and failures of the quants, complexity, leverage, and the breakdown of correlation, manifest today in the world of AI, crypto, and the Robinhood generation. The central question is, have the quants truly learned humility, or has the God complex merely been transferred to the machine? AI, quants, and the transfer of the God complex. The pioneers of the quant revolution have evolved into the AI-driven hedge funds and machine learning behemoths that dominate capital markets. This evolution has made the systems faster and more opaque, fundamentally changing the nature of systematic risk, the AI black box and unverifiable risk. The modern quant method relies heavily on machine learning models that find complex, nonlinear trading signals across massive, unstructured datasets, sentiment, news, satellite imagery. These models are black boxes. They operate using algorithms so complex that even their human creators cannot precisely articulate why a particular trade is executed. The new God complex. The danger is that the mind's intellectual arrogance, the God complex, has simply been transferred to the AI. The new belief is, the AI is too complex to fail, and its pattern recognition is superior to any humans. This blind faith in the machine replicates the quant's initial flaw of trusting the VAR model implicitly, Chapter 2. The modeling of human behavior. Modern algorithmic trading now focuses heavily on modeling human psychological behavior, attempting to systematically profit from retail FOMO, social media hype, and herd mentality. This means the quants are now directly exploiting the noise traders with far greater speed and precision, accelerating the transfer of wealth from the undisciplined to the systematic. Quant strategies and systemic speed. The speed and volume of modern quant strategies amplify the risk of a coordinated crash. The problem of unified liquidation, Chapter 15, remains the single greatest systemic threat. Flash crash risk. The flash crash of 2010 and subsequent mini-crashes demonstrated that the immense speed of algorithmic trading can trigger self-reinforcing panic loops that cause market dislocations, prices plummeting far below fundamental value. In seconds, the method is too fast for human intervention, confirming the necessity of human oversight and the emergency shutdown rule, Chapter 12. The arms race. The ongoing technological arms race, paying millions for faster fiber optic cables, proves that the time factor remains a primary source of alpha. This systemic cost forces smaller, less capitalized quants to take on excessive leverage addiction to generate competitive returns, making the entire ecosystem chronically prone to failure. The crisis of correlation in digital assets. The failure of the quants was the breakdown of correlation. This lesson is starkly visible in today's high volatility, digitally driven markets. Crypto casinos and unmanaged volatility. The rise of crypto hype cycles and decentralized crypto casinos is the ultimate expression of the unmanaged volatility that destroyed the quants. These assets are ruled by hyperspeculative behavior and lack the structural liquidity buffers of traditional markets. Correlation by narrative. While different altcoins may claim unique utility in a crisis, their prices are highly correlated to Bitcoin. This is correlation by mass psychology. When fear hits the crypto space, e.g., regulatory news or a major exchange failure, the assets plummet together, proving the systemic rule. All risk is correlated in a crisis. The leverage trap. The cheap leverage through technology available on crypto exchanges, often 50x or 100x, is the modern equivalent of the LTCM failure, Chapter 6. It allows retail noise traders to use minimal capital to take on catastrophic, systemic risk. The money management pillar, specifically the 2% rule, is the only defense against the inevitable margin call triggered by a coordinated, high-speed sell-off. Meme stocks and unquantifiable risk. Meme stock manipulation represents the purest form of non-quantifiable risk that the early quants failed to model. Psychology over predictability. The parabolic surge in these stocks, driven by social media financial panic cycles and FOMO, is a force that defies historical statistical analysis. The systematic method of the early quants would have shorted these stocks based on poor fundamentals and been annihilated. The modern solution. The systematic lesson derived from the Turtle's Revenge, Chapter 4, is that the only way to manage this risk is through directional flexibility, being willing to go along the trend, however rational, and money management. Trading so small that even a 1,000% irrational rally doesn't inflict terminal damage on the portfolio. The professional systematic trader today must incorporate the power of the machine while simultaneously guarding against the machine's greatest failure, the God complex. The new rule is to assume that the most complex systems will eventually fail in the most spectacular, unpredictable way possible, and only conservative, simple, and rigorous money management will ensure survival. Closing reflection. The journey through the rise and fall of the quantitative titans, the rocket scientists, the mathematicians, and the code breakers, is the ultimate modern parable for the systematic trader. Scott Patterson's narrative, when synthesized with the core principles of Koval and Elder, delivers a singular, powerful lesson. The market does not reward intellectual superiority. It rewards systematic humility and rigorous risk control. The catastrophic failures of quants were not due to a lack of brilliance, but due to a massive, systemic failure in the mind and money management pillars. They believed their complex code made them immune to the simple psychological forces that destroy the amateur. This final reflection distills the most critical, enduring principles learned from the quant revolution, providing a blueprint for the individual systematic trader to survive and profit in a world dominated by high-speed algorithms and unpredictable black swan events. 10 timeless principles for the systematic trader. The following principles are the lessons learned at the expense of trillions of dollars and the reputations of the world's most brilliant minds. 1. The humility of the flawed model. Principle: assume all models are wrong. Lesson: the quants' greatest failure was their God complex. The belief that their complex formulas, var, Gaussian, copula, were perfect representations of reality. The systematic trader must assume their own system, triple screen, trend following, is flawed and will inevitably encounter a market condition it was not trained on. Modern application: never risk more than the 2% rule on an AI-driven hedge funds model whose core logic you cannot manually break down and test against a correlation break. Humility is the foundation of survival. 2. Risk must be absolute, not probabilistic. Principle: define risk by dollar amount, not by probability. Lesson: the quant's money management was built on probabilistic risk, var, which systematically underestimated the risk of fat tails. The quant crash proved that only absolute risk control works. Modern application: adhere strictly to the 1% or 2% rule. Do not allow a complex model or the lure of cheap leverage through technology to persuade you that a position is risk-free. The maximum dollar amount you can lose is fixed, regardless of the formula's prediction. 3. Correlation always breaks in a crisis. Principle: assume all assets are 100% correlated during panic. Lesson: the basis of statistical arbitrage, that assets move independently, was shattered in 2007. When mass psychological panic hits, everything sells off at once. Modern application: the systematic trader must ensure their diversification is genuinely non-correlated, e.g., combining systematic long-term trend following in commodities with passive equity investing. Never trust that your ETF dominance holdings and your tech stocks will save you simultaneously. 4. Speed is execution, not alpha. Principle: do not compete with the machine on time. Lesson: the quants proved that the algorithmic trading networks win the speed race in the milliseconds. Competing on short time factors is a guaranteed path to failure for the human trader. Modern application: use the time factor to your advantage. Focus on swing trading or position trading, daily/weekly charts. where the psychological momentum of the crowd is slower and more durable. Delegate execution, entry/stop loss, to the machine, but reserve strategy designed for the human. 5. Liquidity will evaporate instantly. Principle: manage risk for zero liquidity. Lesson: the quiet crisis and quant crash demonstrated that liquidity, the ability to exit cleanly, vanishes when most needed, rendering the automated stop-loss ineffective due to slippage. Modern application: when trading high-volatility assets in crypto casinos or performing option gambling, calculate your position sizing assuming the actual loss will be 3 to 5 times the predicted distance to your stop-loss. This capital buffer is the only defense against a systemic liquidity freeze. 6. The noise trader is systemic risk. Principle: the collective irrationality of the crowd is a force of nature. Lesson: the quants fail because they underestimated the destructive power of millions of noise traders acting in unison, meme stock manipulation. Modern application: treat social media financial panic cycles and hyperspeculative behavior not as temporary anomalies, but as the inevitable fuel for massive destructive trends. Use your systematic method to harvest the trend's energy, but use your money management to protect against its ultimate violent reversal. 7. Complexity masks risk. Principle: if you can't explain the risk, don't take the trade. Lesson: the complexity of CDOs and advanced quant models shielded managers from the simple, terrifying risk at their core. Modern application: the systematic trader must be able to break down the simple, fundamental risk of every trade. If a trading strategy, indicator, or AI model cannot be reduced to simple method rules that fit Elder's framework, it is too complex to trust with capital. 8. The turtle's triumph: simplicity endures. Principle: simple, systematic rules beat complex. Discretionary genius. Lesson: the turtle's revenge proved that basic trend following and rigorous money management, Koval's principles, survived the systemic crisis that destroyed complex quant strategies. Modern application: focus on mastery of the basics, triple screen system, ATR, and position sizing, rather than hunting for the complex proprietary secret indicator. 9. The human veto is non-negotiable. Principle: reserve the power of stop for the human mind. Lesson: the quant's failure was allowing the code to dictate risk without human oversight. Modern application: the systematic trader must set a human, non-quantifiable emergency shutdown rule, like the 6% rule. When the system hits that maximum loss threshold, the human must override the code and halt all trading to preserve the capital base. 10. Trading is an unfinished science. Principle: the market is not a solvable system. The quants, in their pursuit of mathematical godhood, simply create a faster, more efficient way to destroy capital when their egos failed. Your goal is not to be smarter than the machine, but to be more humble and more disciplined than the machine's creators. By adopting the conservative simplicity of the mind, method, and money framework, and rigorously adhering to the rule of survival above all else, you ensure that you are always positioned to profit from the next inevitable chaos, rather than be consumed by it. Systematic success is the reward for calmness, patience, and absolute fidelity to the code of conservative risk. 5. Outro/subscribe CTA. The journey through the rise, the hubris, and the ultimate failure of the quants is now complete. Scott Patterson's dramatic account proves that the pursuit of mathematical perfection, if divorced from human humility and conservative risk management, will always end in systemic collapse. You have witnessed how the most brilliant minds on Earth, the rocket scientists and mathematicians, were destroyed not by an unpredictable economy, but by their own God complex and the failure of their complex VAR models. You have seen how their catastrophic, high-speed failures validate the simple, conservative principles of money management and position sizing taught by the trend followers. The new rules of the financial game are clear. The algorithmic trading machines are faster than you, but they are also fundamentally fragile. Your only safety lies in the conservative simplicity of your mind and the ironclad discipline of your 2% rule. Do not seek to outsmart the machine. Seek only to survive at inevitable, spectacular failures. This has been a definitive audiobook summary and modern analysis of the quants. How a new breed of math whizzes conquered Wall Street and nearly destroyed it. If this breakdown has reinforced your commitment to systematic discipline and risk control, make sure to subscribe Capitura and ring that notification bell. Because next time, we're unveiling another essential financial classic that will solidify your position as a systematic, emotionally disciplined trader, ready to profit from any market condition, no matter how chaotic. Click the subscribe button, join the disciplined few, and we'll see you in the next one.